Now, better growth in Japan and talk of more stimulus are helping to boost sentiment today, but our next guest believes markets will continue to struggle until governments actually inject a lot more money into the system. Joining us now is Viktor Shvets, the head of thematic equity research Asia-Pac at Credit Suisse. I must ask you,
sure.
Thematic equity research, what is that? What is thematic?
It's basically dealing with themes. That was actually one of the very few ways of making money.
I've never heard it before.
Well, essentially it's looking whether it's demographics, whether it's macro themes, infrastructure themes. One of the very few ways of actually making money in this market.
Okay, how do you make money then with this Greece scenario? You pump money, right?
Yeah, that's the only thing. Europeans are trying to square the peg. There is no solution to the problem they're facing, certainly not solutions they're prepared to embrace. And the solutions are that you need to reflate Eurozone economy, you need to establish fiscal union, and Germany must tolerate a much higher inflation rate. The problem is nobody can agree on that package.
Now, between, as you pointed out, November 2011 and April 2012, $1.7 trillion was injected into the
global economy. That's right.
That is coming to an end.
That is. Within a matter of weeks, Operation Twist will be behind us. Japanese are still spending their 5 trillion yen, but that's largely will be behind us very soon as well. And that's why global economies are starting to stall. That's why we got contradictory signals from the bond market, from equity market, and macroeconomic indicators. Until we inject more liquidity, we will continue to stall and volatility will get higher.
But this is dangerous, Victor, isn't it? I mean, they're injecting more liquidity. Yesterday we had on a guest, Bruce Saxena, talking about go with the alternative, let countries default, which obviously is dangerous, can lead to very social unrest on a very large scale, etc. But without pumping money, there is absolutely no alternative. Rates are so low. What can you do apart from maybe fiscal stimulus?
That's right. There is nothing else to be done. Only fiscal and monetary stimulus.
It's dangerous, isn't it?
It is dangerous, but what's the alternative? Would you like to have a Great Depression? Would you like to have a 20-25% drop in aggregate demand? Are you prepared for consequences, both social and political consequences of doing it? So there is really no alternative but for public sector to support global economy for as long as it's needed for private sector to heal. Now, in some countries, private sector already started to heal, like, for example, in Japan. But in many other countries, that's not the case as yet.
Now, looking at Europe, as we look at this interim Prime Minister again, who his name in English means bitter, and he came in saying this is a joy but also a huge burden.
Right.
Do you believe, from your experience, that Greece will default this year? And do you believe, therefore, the next concern is clearly the contagion? And I include France in that contagion.
Well, the answer is probability of Greece defaulting clearly has increased. And in my view, will continue going on. The bottom line, Greeks either need to drop the currency 30-40%, which means euro has to go below 1 or below parity with the dollar, or they have to have 10-year very harsh restructuring and deflation of domestic economy. Neither of those outcomes are palatable or acceptable, and that's why countries like Greece really have very few alternatives. The only alternative they have is for Germany to pay, and arguably Bundesbank is already doing it. I mean, target 2 balances at Bundesbank are already running at well over 600 billion euros. So unless Germany accepts a lot more, Greece is likely to go. Contagion to other countries, Portugal clearly will be next in line. Now, Spain and Italy are just far too critical. But in the case of Spain, once again, you have a low productivity, you have an overhang of property and real estate, and a banking crisis.
You called it a slow-moving train wreck. If you just let Greece default right now and let it be done, contain it, then focus on Spain and Italy, rather than throwing money, good money after bad money, doesn't that make sense? Because I mean, if it's a 10-year, drawn-out, painful, almost cancerous exercise, it'll be worse.
Of course, of course. It's much better to get it over and done with. Now, there are things you need to do. It reminds me when Lehman's collapsed, when Federal Reserve was saying they have to spray the runway. You have to do the same as Greece. You have to have capital controls. You've got to have ECB pumping money into overnight markets. You have to have a guarantee of deposits. There is a whole range of things that needs to be done before you can actually take the Greece out. And it has to be a surprise, which is very complicated to achieve in a current climate.
When your clients call you up and say, we need really help, we're very concerned, very worried about what to do we just sit on our cash? What do we do? Where do we invest in equities?
Now, if you look at equities, there are still some themes that you can exploit. For example, there is a theme, computer cloud. Upstream component manufacturers to various electronic devices. There is a variety of themes one can explode. But in terms of general macro backdrop, the answer is will remain volatile, correlation of assets will remain very high, and equities generally will underperform so long as there is no clarity on a macro input, either fiscal or monetary.
Viktor Shvets, many thanks for joining us. The head of thematic equity research at Credit Suisse.